Hello and welcome to another week here at Angel Insights, the show brought to you by SyndicateRoom that dives inside the world of early stage investing to reveal the tips, tactics and strategies from the investors themselves. And joining me today, I'm thrilled to welcome Dominic Wilson, managing partner at Pi Labs, founded on the thesis of becoming the centre of the property innovation ecosystem, creating scalable businesses that will disrupt the property sector. And as for Dominic himself, he's got a wide background in private equity real estate, having worked with both AEW Europe and Savills Investment Management, and has transacted over €3 billion of deals across Europe. You can also find further resources on the show and investing articles on the site at syndicateroom.com. But enough from me, so it's now time to welcome Dominic Wilson, managing partner at Pi Labs. Dominic, it's an absolute pleasure to have you on Angel Insights. Thank you so much for joining me today.
No, my pleasure, Harry. Thanks for having me.
Now, I'd love to start by discussing how you made your way into the world of early stage investing and where you are today with Pi Labs.
Sure. As with most things, it was sort of a bit of happenstance. I actually have a background in private equity real estate, so I've actually spent most of my career sort of investing in real estate, which is very closely similar to obviously what Pi Labs does, albeit Pi Labs on the tech side, and we invest in companies. But most recently, I was backing small entrepreneurial residential developers in the UK with sort of debt through a debt platform I was doing at a previous group. So I had some experience in researching, underwriting, and kind of vetting management teams and their business plans. And I knew the chairman here at Pi Labs for I think about 6 years. And then this opportunity came up to come on board as a GP and sort of grow the platform and grow our presence both domestically and internationally. And I started looking into tech and saw that it was pretty absent from the real estate sector relative to other verticals. But that represents a good opportunity. And I like sort of small, nimble entrepreneurial teams, which is exactly what we have here. So, I sort of jumped at it.
Why do you think there's been such little innovation in the property tech space? What's the kind of driver behind this antiquated system?
There's a number of reasons, really. I mean, I think one, if you look at real estate returns and what drives the real estate industry overall, it's obviously an asset-based industry, right, which is just sort of bricks and mortar. And in most cases, I mean, there was a blip in sort of the GFC, sort of 2008, 2009, but in most cases, those assets performed really well, particularly if you're in a place like London where, frankly, you can just sit on your hands and your holdings will just grow 10% year on year. There's a little need, therefore, to innovate. Whereas if you compare that to, for example, fintech, where you've got the incumbents, the large banks facing a lot of regulatory change, that's invited a lot of new challenger opportunities to threaten the status quo. Having said that, I think what we're now seeing is post GFC. Certainly with Brexit, there's a new normal on the real estate landscape, and people are having to work a lot harder to generate those returns from their assets. And ultimately, technology is going to be at the forefront of the tools that they use in order to enhance those returns. And that's kind of why we're seeing a massive leap forward on the innovation front in the last 18 months.
I'm intrigued though, why do you think now is then the time for innovation in property tech? If we can sit on our hands and get 10% year on year, why now? Is it kind of new enabling technologies? Is it kind of the rise of availability of data? What is it to you that lends to this innovative surge?
A combination of things. I mean, I think first of all, the era of sitting on your hands and getting 10% year-on-year returns is over. You're now having to be more creative in how you outperform the market. That's point number one. So what are the methodologies that you can use in order to reach that goal? Secondly, I think there have been a number of big successes on the real estate prop tech side. So in the UK, you kind of got Zoopla, Rightmove, companies that have done reasonably well, like a peer here. The US has had Zillow. Obviously, Airbnb is probably like the most well-known and kind of glamorous of the prop tech success stories. And I think that in turn is woken people up to the value of the consumer in a way that perhaps they didn't otherwise, think about. People used to think about consumers from a real estate perspective in a very kind of binary fashion. And I've actually just written an article about this where it was focused on just as you are a buyer of a property or a seller of a property, or you are a potential tenant, or whereas now you are seen as a consumer within a home. There's a lot of big data around that. Your consumer patterns, your insurance patterns, your lending, your spending habits. All of that now is becoming more transparent, and that is monetizable, and in turn is more valuable. So that has created, companies on the one hand who are looking to, bring those data sets together, and obviously investors and users and consumers, or sort of customers rather, who want access to those data sets and therefore want to pay for it, and that therefore there's a marketplace being formed.
I want to discuss investor specialization now, because as we've kind of figured, Pi Labs is very much focused on property tech. So what do you think are the inherent benefits of having such investor specialization for you?
The rationale for us is quite simple. When we decided to do this, there wasn't a property tech kind of investor specialist in existence. So we thought that was potentially a gap in the market. I think real estate as a sector, in terms of product fit and applicability of technologies, is quite a hard sector to underwrite, right? In terms of if you compare it to a more consumer-focused, e-commerce-based type offering. So if you look at sort of fast tech, or you can maybe some elements of fintech and whatever else. And we all have real estate backgrounds, so we understand the markets extremely well. I think having a laser focus on that market, it enables us to better vet the opportunities that we see. And certainly, the data that we have to date supports that thesis, in terms of our metrics and the success of the companies that we've invested in. Where we are, narrow, I guess, on a vertical basis. And actually, PropTech is wider than most people think. So, it touches sort of fintech, insurance tech, hospitality, hotels, construction, commercial, residential, big data. But where we're narrow in that sense, we're quite geographically agnostic, which is sort of the reverse of most models, right? Most models are sort of sector vertical agnostic, but geographically focused. And so we decided to be very sector focused, but have a wider global appeal.
Do you think it matters then in terms of proximity to your investments with regards to value add and strategic input?
Yeah, I think it definitely does. The way we sort of look at it is we're very comfortable to invest overseas, providing that we're comfortable with the structuring and rules that are in place. What tends to happen is that we see quite a lot of overseas businesses who have developed some traction in the local market but want to come to London. And the reason they want to come to London is because London is, arguably, and hopefully still is after last week, the global capital in terms of real estate. I think every major player in real estate operates out of London, and therefore companies tend to come here. So, and we therefore still have that degree of proximity. But we're seeing, for example, an awful lot of deal flow out of Southeast Asia. And as a result of that, and to address your point directly, Harry, about proximity, we're going to open an office in Singapore next year to better serve that pipeline.
Mm-hmm, absolutely. And back on the investor specialization there, are there any kind of inherent cons that you feel from being so focused on one particular vertical?
Well, yeah, I guess so. I mean, on the one hand, we see. I've seen quite a few fantastic opportunities where people have come to us, not thinking that not realizing that we're sort of prop tech specialists. So where you've looked at an idea and maybe it has like a very loose kind of connection to real estate, but it's actually a great business, and unfortunately you have to pass it on to someone else, which is always a bit painful. But so you miss out on certain opportunities. I mean, we're never going to do the next something like Uber or whatever it is, or some fantastic kind of biotech deal. We won't be able to participate in that. I have to say, from a deal flow perspective, we are absolutely it's immense, and we're absolutely inundated. So I think one would think that you'd have a shortage of opportunities, but we have found that to be absolutely the opposite. And in fact, most companies who are coming to us because we're specialised, and that's what they really value.
You said it's painful passing on opportunities. I'm intrigued at how you deal with the FOMO of being an investor. How does that affect you?
Look, I'm pretty sanguine about investments, to be honest with you. My dad always taught me, always had an expression for sort of take your profits and cry. So look, we can't back every great company, right? I mean, we don't have limitless funds, and nor do we have a crystal ball. So for sure we're going to miss out on great opportunities. The secret of our success to date and the secret of our success in the future will be that we need to back good companies, and we pass on, basically, and making sure that we get those ratios right. If we miss a great opportunity, that might be for a very good reason, right? I mean, we've passed on things that we like a lot, that have been directly within our domain. And that might be because we have a portfolio management issue to consider. We might already have a company that's in that sector. We might feel strategically, in terms of maybe some of our investors or maybe the location, that it's perhaps not the best thing for us to do at that moment in time. There's a number of different reasons that go into an investment decision that we make. And we make that as a committee and as a team. And
what's your investment decision-making process like?
It's pretty quick. It's pretty linear. I mean, look, I run the platform here, and I have sort of overall oversight on all the investment activity. And what tends to happen is our process is normally we meet with a company. If we like it, we sort of go to a second round with a bit more information on financials and everything else. We like that. And once we've gone through their numbers and everything else, we then do an on-site, at their place, sort of due diligence session where we sort of spend 2 to 3 hours with them going through things a little bit more nitty-gritty. And normally at the end of that process, we're in a position to say, yes, it's something we want to take forward, or no. And there's probably like a few other bits of DD and questioning. But generally what happens then is that we just, we do a paper, convene our investment committee, and then we discuss it, and it normally gets approved. I mean, we don't normally take things to investment committee, blind. So we obviously know most of them well. We have 2 external venture capital firms on our committee, or members from venture capital firms on our committee in terms of local, global, and index ventures, and we're in close contact with them regularly. They're big supporters of ours, and that's how it works, really.
I'm intrigued as to kind of check size now, and your strategy on check size and the rigidity towards it at this stage of investing. So how much rigidity do you place towards the check size, and does it vary excessively? I
don't think we have rigidity on the size of the overall funding round that we'll participate in. Our strategy is that we're effectively a seed investor, so we'll do seed, sort of seed 2, seed 3, and Series A, but we only follow one at Series A, so we wouldn't do it first level of time investment at Series A. And we define Series A, just to be clear, as $5 million, right? And some people define it differently. So effectively that means that we're looking at anything from £250,000 to probably £2.5 million in terms of, and that's a pretty rigid frame according to our mandate. I mean, I'm defining Series A as $5 million, which is more or less £3 million, right? So effectively, as a first-time seed investment, we would look at anything below that threshold. So let's say £2.5 million to £250,000. That's the spectrum. That is pretty predetermined and pretty set. But there's a great deal of flexibility within that, clearly. Then in terms of the actual size of the check that we write, our thesis is we're happy to lead, but we don't insist on it, so we're equally happy not to. We simply want to take a meaningful part of the round. And by that we mean normally sort of 25 to 40, 50% of the round. So on average, what that means, I think, is our check size is somewhere between 100 and 750.
And do you like to take a board seat with that investment?
We don't ask for that at all, no. So we're quite different to other investors in that respect. Some investors sort of stipulate board seats, observer seats, and everything else. We are of the view that it should be the founders and the team that determine who goes on their board, who's their lead, and everything else. What we do kind of insist on is that the board is run properly, and that there is an external influence on the board to make sure that certain investor consent matters are covered off. But ultimately, we believe that we spend a lot of time due diligencing and vetting a management team. And if we decide to back it, that's exactly what we're going to do. We're going to back it rather than sort of sit on their shoulders and overlook everything that needs to be done. That's just not our style. So we do get asked a lot to go on boards, conversely, and we're happy to consider that, provided that, we can avoid conflicts and we feel that we have the right time and resource to make it work for everyone concerned.
Mm-hmm. And last question before we dive into a quick fire, regards to kind of co-investment opportunities and co-investors in the ecosystem. So how have you found the angel and the seed funding environment in London in terms of co-investment opportunities?
It's pretty good. It's very good, actually. Obviously, you've got the tax benefits for angels here, which means there's a great deal of angel capital looking for deal flow. We've had a lot of strong angel networks invest into our companies. We've had co-investment opportunities, or people coming alongside us from the likes of sort of Landmark, which is DMGI's investment vehicle. Local Globe has followed on some of our investments. Seed Camp. There's some other big angel networks like Clearly So and Mustard Seed. I think the network here is very strong and getting better. There's a maturing of the market at seed at the moment. I think you're bringing the angel money alongside the VC money. It's not always an easy process because the angels look at things through a slightly different lens. I mean, they're largely looking at it through a tax rebate type process. So effectively, they're buying into the company at half the price that we're buying in at, in most cases, or a third of the price off. And so obviously they underwrite it slightly differently to how we do when it comes to that valuation and risk and everything else. So that can sometimes be a point of contention in terms of how you then set the valuation and set the funding round going forwards. But there's a lot of support, and I think everyone is very keen to see these companies succeed, which is great.
And I'd love to dive into a quick fire round with you now. So I say
go for it.
So 60 seconds per answer. So let's start with, you mentioned tax reliefs. Is this dumb money, and is dumb money a good thing?
It is on balance. Yes, it is dumb money, and yes, dumb money is a good thing. So every investor round needs smart money, but you don't need 100% of your round to be smart money. So having some dumb money in there that's just going to give you money and let you get on with it is a good thing. Yeah.
The effect of Brexit. What's going to be? Obviously, it's a guessing game now, but how have you seen it play out so far?
I think it's all a little bit too raw. I think I seriously doubt we're actually going to end up leaving the EU in any meaningful form, personally.
Really?
I can't see how that's going to be voted through Parliament, and nor the terms on which we're going to leave haven't been negotiated or unknown. So they start to present a package to Parliament to be voted down to repeal the European kind of Communities Act of 72, and that's. If 95% of MPs are in favour of staying, then that obviously raises serious questions about whether that would actually get voted through, right? So I think the shockwaves from the last few days have been, significant. I think from a property perspective and from what we do, it's probably a good thing. And the reason for that is, venture is at the sharp end of the stick as far as risk is concerned. So yes, we're sort of high risk investors with very high risk, high rewards and high returns. But if you go the opposite end of the spectrum, which is your safe haven assets of equities and bonds, but if you look at the volatility in those markets, they're obviously not looking so secure. So actually, why not take the risk with the guys who are going to give you the greater returns as opposed to the guys who are just going to perhaps lose a lot of money or just generate sort of 5-10% return. And lastly, coming back to what we were talking about before, this is definitely going to impact property companies, right, in terms of how their asset price growth and their performance. So they're going to need innovation and technology more than they ever have.
And then what's the biggest challenge for you in your day-to-day role?
That we're a fund and we're an investor, and we have a lot of great momentum and great ambitions. So for us, it's matching the capital requirements to the deal pipeline that we have. We have far more deals that we want to invest in than capital that we have to invest, which is actually quite a nice problem to have. It's better that than the other way around. We're looking to capitalize ourselves better in every respect and to really make sure that we take full advantage of this sort of first mover position that we found ourselves in. So that's one. We are very fast and we're very nimble, and we implement extremely quickly, which is great. but some of our kind of counterparts, certainly in the real estate industry, as we alluded to before, perhaps not so quick. So managing those two processes in terms of like the speed at which we get things done and the speed at which they move is perhaps can be a little bit frustrating. But we're making inroads on that front.
And then I want to finish on your most recent investment and why you said yes.
Our most recent investment was an investment with one of the lead investors into Plantific, which is a home services, home improvement marketplace. The reason we said yes is because it was an exceptionally strong management team. And that's normally the catalyst for most of our investments, to be fair. 2, they had some incredible partnerships with the likes of Zoopla and a few others that I can't really name at the moment. 3, their quality of product and their speed of product development was far ahead of anything else in the competition. And they sort of overcome problems that their competitors had traditionally struggled with. It was one of those deals that was kind of a no-brainer. I mean, it wasn't a no-brainer, but everything we looked at came up very, very well. And from a referencing point of view, I don't think I've ever had a better set of references, and we referenced them quite heavily. They're just a very, very strong team and very, kind of very clearly focused on execution, which is something that we value quite highly.
Well, Dominic, thank you so much for giving up the time today to come on the show, and it's so fantastic to hear more about Pi Labs.
Brilliant, Harry. Thank you for having me.
And a huge hand to Dominic for giving up his time today to be on the show. It really was fantastic to hear his journey establishing Pi Labs. And if you'd like to see more from us, then you can follow us on @SyndicateRoom on Twitter, or you can head over to the site at www.syndicateroom.com, where there's the e-learning academy for investors, where there's a whole host of articles and podcast resources for you to check out. As always, we so appreciate you tuning in and look very forward to bringing you next week's episode on Wednesday.